All right, welcome everybody. Good morning. It is a beautiful day to start learning about accounting. So, here is going to be the introduction to accounting. All right. So, what the topics I actually dive into when it comes to introducing you to accounting is going to be these little things that we'll see. We'll understand the basic principles of accounting, okay? Meaning we'll understand the very fundamentals of collecting data, learning how to sort the data and record it in a journal properly, okay? And we're going to learn how to post it into a ledger, and we're also going to learn how to attempt to do a trial balance to ensure the quality of our accounting, making sure that what we've done for the accounting is accurate. Okay, so in chapter 4, you're gonna learn about the big umbrella organization called GAAP, which is the Generally Accepted Accounting Principles, and they are the ones that are going to give us the guidelines, but give us also the format on how financial information should be recorded. So we're going to be introducing to that. We're going to also be looking at the accounting equation, okay? Um, um, the I guess this equation is bounded for all accounting to ensure that everything is equal and is balanced. And we'll talk more into it when we get into that chapter. All right. And we are going to be focusing primarily on manufacturing, or I'm so sorry, merchandising operations. So we're going to be looking at how sales work, right? What are the rules for sales? What are the rules for purchasing inventory, right? And how to collect either the sales tax, things like that. And we'll also get a little taste of what payroll is. And lastly, we're going to be diving into creating our financial statements. So, in this whole little course of topics, this is all going to be taught in 10 weeks. Yes, 10 weeks. I said it, 10 weeks. Because the last 5 weeks, I'm going to introduce you to a class project that's going to involve every single concept in all of these topics in one case study. All right. So let's go ahead and look at what kind of business activities, right? So first one is we need to understand what is the nature of a business. Okay. If I had to sum up to you exactly what the nature of a business is, it's pretty straightforward. You try to make money. And that is ding, 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 100% true. Because the whole purpose of running a business is you're trying to overall provide a good or service using resources. And with that, you're trying to make money. So with that extra money that you have, you can either reinvest it into your company to go to improve yourself to be in a grander scale. That is what a nature of a business is. It is basically an organization that uses resources to provide a good or service to consumers or to customers. So definitely that is something you want to also understand. So here I have little profit, little profit charts in here and having cash. Now, obviously, the goal is to make money. Now, in order to make money, making money, it means you have to make a profit. And what we're going to be looking at is all our sales and our revenues, right? They have to be a lot higher than all the expenses that we incur in order to make a profit. So we're also going to be looking at in that when we dive into the financial statements. All right, so different types of business organizations. There are a total of five, I believe. Yeah, five different types of business organizations, and how they function is each one has some kind of unique trait or characteristics that differentiates from each other. Now, sole proprietor is pretty straightforward. Sole meaning one person. Okay, so we have a sole proprietor. We have a partnership, right? At least 2 or 3 people, right? And oftentimes you'll see that most small businesses are either a sole proprietor or a partnership. Okay. Now you can also have a corporation, right? Usually that I'll go into details of each one specifically after the slide, but usually you're more likely to see a lot of major corporations out there, such as Target, Walmart. They are the major big bucks earning businesses out there. Okay. And then there's also smaller ones that don't want to be too much on a grander scale, which is a limited liability company. And then lastly, we have non-profit organizations. So if you can think of one right now, we'll talk into it, but they actually function completely different. Of course, they're nonprofit, so their main goal isn't to make money, but how they function is going to be really, really different. So, okay. So I'll go ahead and explain each and every single one criteria. I guess each and every single one. So again, a sole proprietor, right? You've heard it. You heard that whole saying, "Oh, a businessman or a businesswoman," right? Yes, usually a sole proprietor is one person and one person only. Okay. Now, what this person does is they are the sole owner. They're the only one who owns the business, okay, and does all the daily transactions or activities for the business. All right. So what happens is that because they themselves are what do you call it? They themselves, the person and the business is one. Okay, so that means anything that you personally own, it's also the business also is considered your own asset as well. So anything that you own for the business and everything that you own personally is one. Okay. Now there are fine lines on and rules on about that, but think of the sole proprietor is that man is that business. So there's only that one person. So that means all assets, liabilities, and earnings is dealt with that one owner. Okay. So the owner and the business is one. All right. Now a little I guess a little fun fact here is it's a little I guess what do you call it? A little tax FYI here. Apparently there are rules to if you establish yourself as a sole proprietor, you have to make a profit at least I believe it's 3 years out of the 5 years for yourself to sustain and maintain a sole proprietor or a business. And if you fail to meet that criteria, that business actually becomes a hobby and you would actually have to pay a lot higher taxes because ultimately if you go into being a sole proprietor, you do get some tax breaks here and there. But unfortunately, we do have that rule. If you don't make three out of the 5 years, you don't make profit for 3 of those years, it actually IRS or the government or whoever the organization is will look at it and say, you know what, you're not a business. You're it's just a hobby that you enjoy. And yes, there's a lot of things that go into it when you're dealing with business in general, especially when you're creating your own company. All right. Sole proprietors, of course, I'm going to go ahead and tell you what the advantages and the disadvantages are. All right, as you can see, they're listed, but I will explain a little more as well. So some advantages of being a sole proprietor is, number one, it is the most easiest and less expensive way to actually create or form the business itself, okay? Anybody can go down to the state or to the local government, sign up and get a business license in a snap. All you need to do is pay, I think right now it's about like $100 or $200 just to apply for a business. You get it approved by whatever, either local or state agency, and you get it in the mail. Easy as that. It is so easy to build a sole proprietor, right? It's like putting up an easy tent, an easy up tent. It is that easy, all right? And then second thing is owner has full control of making all the decisions for the company. Now, of course, with all that power, you can only assume, is this owner making all the right decisions? Or is this person just out for the money, you know? And usually for sole proprietors that want to create this kind of type of business, they need to be money hungry, right? They need to want to make the profit. So making every decision, you know, no one can tell him no, right? Because the owner is the business itself. He has full capability on how he wants to run his business, the way he wants to run his business. So right there is where ethics will start flagging in, okay? Number 3, the owner can keep or reinvest the money. So all of the profits that this person makes, it's his money. It's his money. Remember, because the man and the business is one. So therefore, if the company is making money or the business is making a lot of money, that money is the owner's money. Okay? So the owner, obviously, you have that little choice. Now, if you're a small mom and pop shop, sometimes like you may think pulling the money out is the best choice, but again, you also want to sustain. You also want to keep sustainability. Like, you know, you want to maintain and sustain a business. So the best way to do that is to reinvest your money into a company. But all profits is 100% the owner's property. I mean, it's all the owner gets to keep 100% of the profits. All right. And then personal tax deductions, yes, you can. But if you own a business, you can actually write that off as part of your own personal taxes. So that's also really cool about that. And then lastly, it's also easy to dissolve, meaning if I can put up an easy tent, it should be easy to take down. So that's also a good advantage. It's like, maybe I don't enjoy this business anymore. I can easily just crumple up the paper and just say I'm done. Well, obviously there's actually rules and guidelines in order to properly close out a business, but what I'm trying to say is if you can create one, you can easily take it down. All right? And you don't need to involve many people when you're dissolving your company. So disadvantages to owning or creating a sole proprietor is going to be 100% responsible for all payments and liabilities or debt. Meaning, if you, let's say most common mistakes, or I guess most common, okay, I would call it a mistake, is when people build their they build their business, right? You're more likely to be, might be easily acceptable for a business credit card or a business loan. Now, a lot of mistakes that a lot of people do is they think, oh my gosh, I own a business, I have $50,000, I can buy whatever I want. No, 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 no. If you do that, you are 100% responsible for all of that debt. As in, if you don't pay that debt back, you can lose your car, your house, anything, because when you are doing a sole proprietor, right? You and the business is one. So therefore, just because, yes, you do need, I'll talk about this when we go into GAAP. Yes, because your business and your personal are two separate things and you want to keep them separate, because you're using your personal assets as collateral in case something happens to your business, right? So you want to, that's the main thing is, if you owe $50,000 to the bank because you decided to open a business and you're not making a profit because you decide to blow your money on buying yourself a brand new car, you can definitely expect that that car can be taken at any given time. And especially these creditors, they don't go after those $50,000. They go after the interest too. So you can lose everything when it comes to building a business. So you definitely want to be careful with that. Even if you have legal lawsuits, you cannot separate. You cannot separate the man from the business unless you are a limited liability company or other entities. Okay. So you are responsible for all payments, liabilities, and debt. Okay. Second thing is going to be all businesses and personal assets are at risk, which I just talked about. So again, if your business is sinking, everything that you own, whether it's your house, home, car, you can lose it all because they're all at risk. Okay. Limited, so you're limited to using personal savings or consumer loans. So again, I think nowadays, if you are a small business, you are, like I said, you are most likely going to be applying for a business credit card or a business loan. If you have extremely good credit, you might get approved right away. If you have really low credit and this is your first time owning something so large, you may be denied. But in a couple years later, once you've proven to your creditors that you paid off your bills on time, that you're more likely to get a commercial loan, or I'm sorry, a consumer loan, which is a little business loan that the bank offers to you. But yes, you are actually limited to actually your own personal savings in order to create a company. But nowadays, I've seen that a lot of small businesses, they do get approved for business loans and business credit cards. Okay, so yes, and that's the disadvantages. Yeah, you're not getting a lot of money to start your own business. You would have to invest your own money. All right. And then number 4 is does not attract high caliber employees, meaning that most likely if you have an employee, they're just going to be like, oh, this is a job. This is just to get by. It doesn't appeal to them because, as a small business, you can't actually offer many things to your employees. Reason being because when we move into payroll, you have to pay a huge portion towards their own, not their own, but your own taxes for having employees, period. Okay. So you don't want to have employees, but they don't even want to work for you either. If you're going to work for a company that has zero benefits, I mean, as most jobs are, there's no job security. There's no things. What happens if you have an emergency? You're not very secured. So that is a disadvantage when you are dealing with having employees that are actually motivated to actually want to work for you if you don't supply those benefits. And then yes, I just talked about number 5. that you wouldn't be able to afford employee benefits, nor can you, yes, because having employees is very expensive, and we'll talk about that in the future. All right, so that's the disadvantages and the advantages of being a sole proprietor. It's the easiest thing to build. It's the easiest thing to tear down. The only bad thing is, you're just liable for everything in the store. All right. Next thing we're going to do is we're going to talk about partnerships. Okay, so partnerships is also easy to establish. There are two different types of partnerships, and oftentimes you will definitely see the second one, the limited liability partners. Okay, but the first one is going to be a general partnership. Okay, this is where two or more people, so you can have three partners. Okay, it doesn't have to be just two. It's where two or more people own a business. Okay, pretty straightforward. Meaning each partner is responsible for a certain position or even a certain task, right? So in most cases, they are split completely even. So that means the money that they earn is split evenly, or whatever you agree to. And all the responsibles are split evenly. Yes. So that's what a general partnership is. Okay, it's where you have a group of people, or two or three people, and everything is split evenly amongst those three people. Right. So yes. The next one's going to be a limited liability partnership. So again, the unique thing about this one is it has to have at least one general partner, as in one person, one boss that's running the whole meats and potatoes of the business, right? They're running the business, and then the other one is you have a silent partner. And what a silent partner does is that person is the investor. They're the person that wants to help out this person by investing their own money into it. Now, with that being said, meaning I'm doing all the work while someone's right there doing nothing because they just helped me invest in my company, but I have to do all the work. Okay, so that's a limited liability company. That's a limited liability partnership. So, with that, oftentimes what happens is that the silent partner, right, for whatever amount that they invested, usually that's how much they profits there is going to be split off with them. Okay. There's also what I've seen also is you guys can go into a contract where you're saying, okay, well, if you invest 25% of the company, right? You could take 20% of the profit, and you can own, you can, if the company dissolves at some given point, you can have these assets. You can make an agreement to whatever you want as long as the silent partner and you agree, and you make it strict that you have at least one general partner. Now, you can have three partners. Two of them are general partners, while one is a silent partner. You can have a mixed variety of however it is. But typically, that is exactly, and most oftentimes, you will see this type of partnership more often than a general partnership. Okay? So what are the advantages and disadvantages of having a partnership? Well, the first one is, an advantage is it is also easy to establish. However, it does take a long time, because if you and your best friend decide to make a company and call yourself a partnership, you guys have to go from square one all the way to, I don't know, 2000. You guys have to agree on every single thing. Every decision that you make will affect each other. So that means agreeing on profit, agreeing on when you dissolve, who's going to take what, agree on what tasks, what responsibilities do you have. You're responsible for accounts payable, receivable, and inventory. I'm just responsible for just being the boss. No, I'm not going to agree to that. That's too much work. So again, coming to an agreement is the most difficult part, especially if you have more partners involved, right? It's going to get it's going to take a lot longer to establish an actual business. Now, what a lot of common people do is, it's also a mistake too, is they go into a partnership and they think it's so easy. They're like, okay, I agree, we'll just split everything 50-50. And then all of a sudden, this partner's not doing work, this partner's not agreeing to what they signed in the contract. You get into fights, and what do you know? You guys decide to, hey, I don't need you anymore. You get out. I know this is half my company. So you guys are going to easily get into arguments. So, we'll talk about that in the disadvantages. All right. So, and then second is your ability to raise funds. Yes, if you have more than one person, you're more likely going to be able to easily raise funds. Okay, meaning, what's that saying? Two heads are better than one. One person could be really nifty at sales, or they just know how to sell things, or a really good sales representative. They may pull in the more money, and while you're on the other side could be doing fundraisers, or maybe you're looking at different organizations to partner up with to so they can promote you. Whatever it is, you have 2 people or 3 people to be able to maximize your profits in different ways. So ability to raise money is it's gonna be a lot quicker. All right. Third thing is tax deductions for profits. Yes, you can actually take a tax deduction if you are a partnership. So I don't go into detail for tax, so I'm just letting you guys know. Just I guess a little piece of taxes. Yes, you get to take a tax deduction if you're a partnership, and each person gets to take it. So you get to double dip, I guess. You could call it that. All right. And then lastly, hiring employees may actually become part of the partnership. So again, if you are looking into having, let's say you don't have any lineage, right? And you're hitting that age where it's about time to retire, but you still have a company and you want it to keep going. So what you can potentially do is you can have employees that work for you that are super, super loyal to you, that could potentially become either a partner or even the owner of the business. So yes, that actually draws attention for employees, just because you can. It's a bonus. All right. Now, disadvantages. So again, I have already said it before that each person has their own responsibilities, and if they don't comply to their responsibilities, then partners are responsible for their own part, and if they don't do it, you guys are just going to get into arguments and disagree. Now, one thing, I don't remember the exact rule, but there is a rule where if you guys are in a general partnership, one person, let's say you're in a meeting, one person can't make it, that person can make an executive decision for the entire thing. But if the other general partner does not know about it, that decision can be avoided. As in, that decision can be appealed. Now, if that person makes an executive decision and he tells the other partner what that decision is beforehand, so he's aware of it, then that decision holds. So, again, if a general partner, one of those general partners, decides to make a really bad decision on your behalf, and you do it, you guys are ultimately both responsible for that decision. Okay. But there is that rule where if that partner did not have a clue, did not know what was going on, and that partner made an executive decision, you can revoke that decision. All right. Second thing is profits are shared. Yes. I don't know about you, but I don't like to share money. As most common businessmen do, or businesswomen, whatever you want to call them, business people. They don't like to share money. And you know, when you're coming into a business, right? And you're sharing a profit, let's say you have two people, 50-50. You know, you kind of come to the conclusion where I worked harder than this guy. I should definitely get a higher profit. No. Profits are shared. You cannot take 100% of a profit. You can only get whatever you're limited to. So you may look in your bank account that, oh wow, we made $100,000, but realistically only 50,000 is actually yours. Okay, so that's it. I guess that is a slight disadvantage, just depending on how you view profits. And then 3 is disagreements. Again, we just talked about that. That is very core reasons why most partners dissolve, because of disagreements, like not agreeing. You signed the contract, but you're not doing this kind of thing. So definitely that is something you can't avoid. And then number 4 is some employees' benefits are non-deductions to a business. I don't know too much details about, or I don't remember too much details about that one, as far as employees taking a deduction when you're in a partnership. But that's just one of the disadvantages to that. And then lastly, limited life in a partnership, if a partner leaves. Okay, so again, if you guys come to a conclusion where you guys disagree to the point where a partner leaves, obviously a partnership, you need to have more than one person. So the lifespan of the business could be very short if the partner decides to leave. Now, if you have 3 partners, you should be okay. But remember, if you have a change of owners or partners, you do need to report it to the IRS or whatever local or state agency that actually licensed you for the business. You need to report it to them as well. But yes. But again, if a partner does leave, the company can shrivel. All right. So next is going to be corporations. Now, so what a corporation is there are 4 characteristics to a corporation. So instead of the other 2, which is only has a couple key factor points, corporations actually have characteristics that makes it a corporation. All right. And the number 1, I guess, unique factor of what makes a corporation is you don't have a single owner. You have what's called shareholders. All right. Shareholders is the company. It's not run by one person. It's not owned by one person. It is owned by multiple people. Okay, so shareholders are limited, and then shareholders are limited to liability. It's its own entity. All right. So again, shareholders is what makes the company a corporation. All right. There's no real owner. Second thing is a central management or some kind of central government. Okay, so usually what happens is shareholders, they elect the board of directors. So in most decisions of the board of directors, it's usually grounded by what the shareholders want. But then again, The shareholders elect these people to make those decisions for you. So, the board of directors have control of when to pay dividends, which is pay out your profits, or or maybe they need to either agree to reinvest in the company or invest in a project XYZ, right? You have a central management team, which is the board of directors, to make executive decisions on your behalf as a shareholder. Okay. And then number 3 is transformability, or what is that? Or shares. So again, what that means is it has the capability to distribute profits, which is the dividends. So that is another key factor, is because you have to pay to own a part of the company. Another key characteristics is that you have the possibility to get profits through a dividend. All right, and then lastly is going to be continuity of life, that will live beyond its life. Okay, so for example, because you guys are based on shareholders, right? If you're a small company, maybe the most that you'll have is like at least 100 shareholders. The company will last and be forever until there is 0 shareholders. Okay, there has to be at least 1 shareholder to have the corporation continue its life. All right. So can you imagine a major corporation such as like Target or Walmart, who have like millions, no, not millions, I'm sorry, like hundreds and thousands of shareholders, and you're saying that this company can last as long as there's at least 1 person? Oh, just thinking about that it always makes me wonder. But yes, a corporation is a business entity that is incorporated by either the state or local agency that's headquarters in by law. All right. So again, in order to actually become a corporation, you do need to file permission by the state and or the local agency that you are headquartered in. So yes, being a corporation, there's a lot more work to it than just simply applying for a business license. You need to have you need to have all these 4 characteristics, and you need to have especially enough funding to be able to establish a corporation. So of course, if you think about it, you think about any corporation today, think about it. It took them probably a long time or many years to actually form a corporation, all right? Because it's not an easy process, okay? You have to go to the government and actually request, and you have to be approved to become a corporation, right? All right. So advantages and disadvantages to corporation is, so an advantage would be shareholders have limited liability, as in if the corporation were to crumble, anybody that's a shareholder that owns a piece of that company, they are free of everything. They don't get charged. They don't get their assets are not going to ever be taken away. Their only contribution is whatever money that they purchased the stock for as a shareholder. Like, how much money did you purchase to become part of the company is what you're limited to. That's it. Everything else, personal assets, nothing. Now, there is an actual rule too to that as well, is if you actually own more than 50% of the corporation, then yes, your personal assets can be at risk, subject to at risk. But oftentimes, usually when you do that kind of thing, you have legal people to work on that case for you to protect your assets. All right, so that's a little side note there. But number 2, shareholders are only held accountable for the investment. So I just talked about that. Number 3 is raise additional funds through selling more stock. So yes, in order for a corporation, right, to raise money, usually, they entice other they entice other shareholders by saying, hey, I have stocks available, please buy it for me. Usually they will have a sale on the stocks, so they may drop their value to entice people to want to purchase part of the company. And that's the easiest and fastest way to raise money for a corporation, besides their main fundamental of what kind of business activity they are, whether they are manufacturing, merchandising, or a service company. The fastest way is to just sell stocks. Tax deductions for having employees. So I'll only briefly talk about this. The difference between a C corp and an S corp is they're not different entities. Okay, so just be I guess aware that a C corp and an S corp isn't the different type of corporations. It's just the different types of ways that you're getting taxed for. Okay, so understand that you when you have employees, you get different tax deductions. But when we move into when I talk briefly about actually I'll talk it out. When you're a C corp, right, you get taxed twice, meaning you get taxed for your personal profits as being being an owner of the corporation, and you also get income tax. So you get taxed twice. So that's why, meaning having employees, the company gets taxed twice. But if you apply as an S corp, you only get taxed once, and usually it's for the personal income tax. So if you do receive profits for the corporation, you just get taxed on that. Okay, so that's the difference when you're dealing with the two different types of taxation. Is C corp you get taxed twice, S corp you get taxed once, and that will fall under the advantage because it's better to be taxed once. But then again, if you maximize your taxes, therefore you don't have to pay more taxes, as they quote unquote say. All right, and then lastly, they can elect they could be elected to be either taxed as a C corp or S corp. So that is actually an advantage right there, that they can choose to be taxed only once. All right, disadvantages is they require a lot of time and a lot of money in order to establish a corporation, which we talked about this, right? Corporations such as Walmart, they long ago started as a small business, and look at them now. How long did it take them to finally become established as a corporation? You can go ahead and look up the history for that, but it took them a long time. Just because I think the key factor is once you've seen that a company is promising to do very well, right? Everybody knows Walmart, everyone shops there. So getting the people to want to invest or become a part ownership of the company, right? The only major factor is Walmart a reliable company that can guarantee me to have profits at the end of the year, right? That's the fine line of why people invest in a company. And it takes a lot of time to build up a reputation and to even establish a corporation itself, right? Next is going to be monitored by the federal government. So yes, monitored by the federal, local, state, whatever agency. Why? because you need to follow their guidelines too. Most corporations, right? They are 100% being controlled by the federal government, right? The federal controls the company because of many reasons. Enron is one of them, right? Because they want to make sure that, you know, are you following the guidelines and rules of US GAAP? Are you properly distributing dividends to your shareholders? What are you really doing? So they want to make sure that you're monitoring and doing everything right. And then lastly, higher taxes and are taxed twice. Usually it's a disadvantage, especially when you're a C corp. Okay, you definitely don't want to be taxed, because higher taxes means less money that you get to take home. All right, let me see. Okay, we're good on time. I'm going to go over the last two business organizations, and then we'll call a break there. Okay, so let's just push through for the last two organizations. Okay, so the last two is going to be limited liability company. And so this one is the only real, I guess, fundamental or underlying reason this kind of entity exists is because it is a hybrid between a corporation and a partnership. So this is what I was talking to you guys about when we were dealing with partnerships, is that for any reason that you want your assets to be protected, you would have to establish yourself as a limited liability company. All right. So, meaning that whatever the partner does, their personal assets are not at risk. Okay, we'll talk a little more into detail about that. All right, it is not a corporation, and it's also, but it is a legal company entity. Okay, so it's its own established type of business organization. It has characteristics. So the key thing that it has to have is it has to have at least two characteristics of what a corporation is, but it can follow the guides and rules and guidelines of what a partnership does. So, distributing profits, as well as just investing itself. So it's not technically a corporation, but it does have characteristics of a corporation, and it has to at least have two, I believe. All right. So advantages of a limited liability company is going to be taxation. Can be taxed as a corporation level or as a corporate level, or it could also be taxed at a at a partnership level. So they have the flexibility there. All right, and they can choose to either be an S corp or They can choose to be taxed as an S corp or as a C corp, but obviously you would definitely want to choose S corp. So they do have flexibility when it comes to taxes. All right. Other things is limited liability. So again, if partners go into if two people go into a partnership, right, their personal assets are not going to be at risk, right? It's going to be limited liability. So for whatever the person either invests, as in their own money, or whether they got a business loan, that's all they're limited to. Okay, and they can also elect one member to be the entity. So in this one, it gives you kind of freedom. Like one person can take sole responsibility for the company, while the other people, they're just part of the company. They just own the company. So very similar to a general partnership or a limited partnership. And then again, no annual shareholders meeting. Again, it only needs to meet two characteristics of what a corporation is. So it's not necessary to have a shareholders meeting as in You don't need to make executive decisions based on the shareholders. The shareholders don't elect a board of directors, but you can, basically, you don't need a meeting. You don't need to involve your shareholders when you're dealing with this kind of company. And then number 5 is less administrative work and record keeping. So again, not too much admin work, meaning like you have designated people to run the business for you. Again, you can elect that one person to be the entity, run the whole business. So it's less work for other partners when they're going into a limited liability company. And then lastly, memberships, interest can be assigned. I'm not quite sure what that one really entails as far as what that truly means, but as a limited liability company, you can be given a membership and you can assign it. So again, you can elect people to be in part positions of whatever to run the company, right? Disadvantages is at least 2 owners or members. So you need to have at least more than 2 people to run a limited liability company. If you have 1, I'm sorry, you can't do it. You need to have at least 2, right? And the second one is can have a limited lifespan. So again, if your partners decides to leave, your LLC can be dissolved. So again, with that number one criteria of having at least 2 people or 2 members to be part of your limited liability company, depending on how the company's run. Of course, if it's a good company, then you're more likely to stay. If it's a bad company, you're more likely to leave. So just meeting that 2 people requirement, it can be difficult and can determine the lifespan of your company. Number 3 is may have employment tax. So I'm not quite sure too much about this specific disadvantage. Again, because I've taken tax before, but again, I don't enjoy it. But I'm not quite sure about the self-employment tax. I'm not quite too sure about that, but it is a disadvantage. And if profits exceed 50%, it will be taxed by the federal. So most often companies, depending on what company they are, the highest profit you'll ever see is nowhere near 50%. So yes, so if you make more than 50% profit, it will get taxed by the federal government. All right, and it cannot take advantage of stock options. So again, most limited liability companies, if you become a potential partner or member of this company, unfortunately, you won't be able to take the benefits of stock options, which is, in other words, it's a retirement plan where you can own a part of the company as long as you live, or even if you leave the company, you have that option called stock options to have ownership of the company. So that, I guess it's a disadvantage that you would be able to have that option. Other ones are going to be some states tax LLCs. So definitely do your research on to see which states actually tax LLCs. I want to say, I think Vegas or Nevada, they do tax their LLCs. And then lastly, converting all existing business into an LLC can be taxed for getting approved getting for appreciated assets. So again, just establishing or just creating an LLC, it's not as easy as again, not as easy as being a sole proprietor or a partnership itself, but it's definitely something you want to look into, especially if you don't want your assets to be at risk. But there are rules and guidelines. You do need to meet two of the characteristics of a corporation, and yeah, there may be things that you could definitely be taxed for converting into an LLC. All right, lastly, I would like to introduce to you a nonprofit organization. So here are very, very popular nonprofit organizations such as PETA, not us PETA, but the animal PETA. We got Comic Relief, St. Jude's Hospital. We have all of those are nonprofit organizations. Okay, so their main goal and purpose is to spread education. Right? They are not in it to make money. Now, what they can do is they can promote themselves by saying, if you buy a t-shirt for $10, you would help this organization grow. Okay, that's not making a profit, because that's not your goal. Your goal is to spread awareness. And what kind of typically these kind of organizations are usually for charities or volunteer work. Typical ones that you would see are anything that are for service, for cultural reasons, educational reasons, professional reasons, religious organizations, any kind of thing that you can educate an individual on, or educate the public on, I should say. Typically, you can establish yourself as one of those. But one thing that you cannot do is you cannot make, the whole goal of it is not to make money. Okay, that's the purpose of a nonprofit. Okay, so there is absolutely no owners when it comes to nonprofit, right? It's purely based on volunteer. It's voluntary, as in you're not being paid to go to run an organization. However, I've seen organizations where they raised money through fundraisers, or having a whatchamacallit, the LA AIDS Walk, right? That is funded by obviously the AIDS or nonprofit organization. They raise money by having people involved and just doing a walk, right? So by then, they raise a whole bunch of money. You can buy merchandise, as in, I'm going to support AIDS by buying a t-shirt, buying a wristband. All of that is a way to raise money. And with that money, of course, they always tell you 100% of the profits go to research and whatnot. That's not 100% true, because some of that money actually goes to pay these people to be able to operate and run these kind of things. Because running an organization itself, it involves a lot of time, and some people, like, they're not motivated unless they like truly believe in the cause. But not many people are motivated if there's no incentive to work there. So oftentimes when these organizations, they hold fundraisers, or they support the community somehow, or even have the donate button, right? You can donate. You can go to their website and donate, right? That money, a small portion of it, does actually go to fund the organization via paying the people to run the business or organization, but ultimately to also pay for the expenses. It's expensive to run a business, right? You need to pay for the facility, things like that. There's a lot of factors when it comes into organizations, and we will look into it when we dive into understanding what it takes in order to establish an organization, period. All right, and again, nonprofit, and they get special taxes. So, because they're nonprofit, okay, they don't make money to make money. They make money to donate to other causes or other research, quote unquote. They use their money for some other reasons besides trying to make a profit. They do it to fund research. They do it to, get their education to be able to spread it around. So that's the difference between the 5 organizations. I know that was a very long piece, but right now I'm going to stop here, and we will continue the rest of the PowerPoint after the break. Okay.